Cool. Yeah, hello everybody. I'm Alex. I'm working with Early Bird Venture Capital. We are kind of a conventional old school VC firm, still digging into this sector. We've done 2 deals so far, which some of you might know. That's BigChainDB and Shapeshift, the most recent one. And yeah, internally I'm very happy to cover everything decentralized for a while now. I'm heavily engaged with the sector also for my for personal reasons and the passion. Yeah, I'm happy to use the next 10 minutes to talk a little bit about the perspective VC funds have on the whole sector. So that's basically the 3 topics I'd like to touch. The pain points of venture financing as we know it today. Followed by the rise and impact of crypto tokens, especially on the financial side of the world. And then finally finish with a brief outlook. So how many founders are in this room? Okay, that's a lot. I would say about 25% of all people. So then most of you will be very familiar with the pain points startups are facing when raising a financial funding. And there are many pain points actually. So the first one is it takes a long time. It's about 6 months doing a roadshow, more or less get a lot of no's, what can be very frustrating. And it's also for even more matured companies still a big pain point with regard to access to capital. Think of projects or like matured companies such as Medium or SoundCloud, for example, which both have very strong communities, supporters, customers who would love to directly invest into those companies as a shareholder, but can't because they're excluded by law, basically. That's only accredited investors and institutional investors getting in this game. Another big problem is what I call the hit big or miss big approach. And that's very much related to the very fundamental business model of venture capital. So imagine you're working with a VC firm and you're raising a fund of 100 million, early stage for example, and what happens then is that you allocate this money by investing into about 30 companies in seed stage and Series A rounds initially. And history has proven that out of those 30 companies you're investing into, about 25 won't bring you any significant returns because they become either write-offs or bring you back your liquidation preference at 1, maybe 2x the money you invested, and that's not enough to make your investors, that's the LPs, limited partners, that's the guy giving money to us, to the venture capitalists, to make them happy. So what we need is companies which have the potential, at least in early stages, theoretically, to become very valuable, speaking about 300 million euros upwards, and the consequences that many very interesting projects and companies won't get VC money because they just don't have the potential to become big enough. That's in many cases the reason for me to say no to very strong teams, very cool products, visions, everything is right, timing, but just the sheer potential isn't there, and that's a big problem also on a global level and on a macroeconomical level. For LPs, it's a different thing. Of course, they compare venture financing to other asset classes, and there might also be more attractive alternatives. So what's the consequence of this business model, or of the hit big, miss big approach we've seen over the last decades? It's basically the creation of centralized networks. So as I said, VCs are looking for very special animals out there, and typically those companies with the potential to become very big show specific patterns, and that's something such as network lock-in effects, hyper-growth mechanics, viralities, creation of significant new markets, or even shaping, creating whole new industries. Some of those you're very familiar with, and they bring a lot of value, a lot of benefits for many people, but they also come with certain downsides. And these downsides are getting more and more obvious these days. I just threw in some buzzwords here. So, algorithmic abuse is a huge topic. Censorship, filter bubbles. Think of the power Google or Facebook have, for example. Single points of failure. Think of our server infrastructure, Amazon Web Services, shutdowns, for example, mass surveillance. What comes to my mind? Apple phones and NSA backdoors. Wealth creation for very few people. That's mainly the shareholders, maybe early employees of those companies. Maybe think of Silicon Valley, of Brexit, of Donald Trump. We have a huge gap of rich and poor, and this is also driven by these developments. Lack of innovation. If I see a company attacking Facebook, which might have a very promising product, making the whole thing maybe 3x better, probably we wouldn't do it just because these giants are too powerful, and so that's slowing down innovation. The good thing is many people in the room and a lot more out there are building solutions to address all these problems, and I can now only talk about a few of those. And the first thing I want to talk about is what's so special about crypto tokens. I'm very much surprised about this audience. Pretty cool that so many people raise their hands and actually hold different tokens. So I just assume everybody's familiar with how you could categorize them and what different kinds of tokens are out there. But generally speaking, they all share some characteristics they all have in common. And that's at first liquidity. In the equity world, there practically aren't any secondary markets, right? If I'm holding shares of a company, I need to wait for the next financing round, and then if I'm very lucky, I could find somebody buying some from me, but it's not very liquid, whereas tokens can be traded right away. Access, that's also addressed. The equity world is very exclusive, also very local. So usually companies are raising money from the VCs within their ecosystems, at least in early stages. That's different for tokens and ICOs. Everything is global from day one. And the growth mechanisms are very, very interesting. So what we've seen in the past are network effects, right? Facebook is only cool if your friends are hanging out there. Otherwise, it wouldn't work. And in the token world, there's something even much more powerful, and that's basically kind of a 2.0 version of Facebook, where Facebook is not owned by any shareholders anymore, but by the users providing content. So the effect is that the more people are joining the networks, the better its usability gets, and also the more the underlying tokens appreciate in value. What is kind of a network effect on steroids. We've never seen something comparable. That's crazy, just crazy growth. We've seen one chart. There are much more. Execution of rights is a topic where we're still at the very infancy. I think there's much more room for improvement, to use smart contracts and bake in specific rules, make tokens more equitable, so to say. It's very experimental still. Of course, in the equity world, you would need to go to courts, what takes time, etc., to get to your right. Capital efficiency now, that's something where I see still a lot of problems in the ICO world. Many projects are raising way too much money in early phases. This could easily be prevented by using smart contracts or raising money in multiple steps, define whatever kind of milestones, etc. So that we need to improve. And of course, due diligence and regulations is a topic in the equity world. It's pretty much standardized. You definitely know which KPIs to look at and which red flags there might pop up, etc. And in crypto land, it's still a little Wild West, and many people, also Chris Burness, for example, I also did some research work and published it lately, is still Wild West. Okay, so what's the impact now on the world of venture financing? Having understood the basic characteristics of those tokens, there are some people, some very strong thought leaders, such as Naval Ravikant, the founder of AngelList and CoinList, who very recently stated, quoting now, "You can basically throw the venture playbook out of the window. This, by referring to token sales and ICOs, completely destroys the existing venture business model, which is based on proprietary access early on. Now everybody has that." That's a pretty strong statement, and I have to admit, the first 5 seconds I was thinking about it, I was kind of agreeing, but reflecting more and more upon it, I don't see it this way necessarily. So I tried to get some data, given the short period of time. ICOs are outvaluing early stage VC funding volumes, was a headline in an article which was published a month ago. And that's obviously true. The dark graphs you can see are reflecting the volume of ICO funding, which is significantly going up, especially in May and June. This year, I think if we continue the momentum of the sector, it will get the gap will get even bigger. That's very interesting and also kind of alarming for many VCs. But the most important thing, or the question we have, like what would be the impact on institutional investing, isn't answered by this slide because it doesn't tell us where the money comes from. It's just saying we're using new mechanisms to raise money. And I couldn't get any reliable data, at least. All these analysis of token distributions after ICOs, etc. And there you can see some percentages, but you still don't know who exactly is behind those public keys. What I see, though, is that indeed institutional money is getting in the sector. So as Sven mentioned, there are these kind of crypto millionaires and whales, etc., coming from this ecosystem, specifically miners and exchanges, which are throwing a lot of money into the pot. But there are also more and more so-called crypto funds coming from different backgrounds. So could be VC firms, for example, Union Square Ventures, Andreessen Horowitz is mentioned here, which are directly investing in tokens. And there are others exclusively investing in tokens, such as Polychain Capital, etc. So they are gearing up, and institutional money is getting into the sector. It's just about to happen. And then, of course, as a founder, you will always ask, okay, why would I actually need to work with these institutional people? Why shouldn't I just go with the retail investors? Might be easier. I get a better distribution, and I think there are reasons for this. Value propositions for founders could, on the one hand, be that usually professional VC firms and also crypto funds will have a deep expertise network and really understand what they're doing their homeworks. So in case the founders have run through kind of a due diligence process and the funding is announced afterwards, this could help to be very strong signaling into the markets. ICO structuring is another topic. It's somehow related to equity financing rounds. There are, of course, differences, but I think the mechanics we're going to see are going to be baked into the token. And there will be parallels. And also long-term reliable partners. A lot of people, be it retail investors or also some of the institutional players, miners, whales, etc., are following pump and dump schemes. They get into the ICOs, make their money, get out their 5x, and dump it again, what isn't very sustainable. And entrepreneurs have an incentive to have long-term partners as well. Value prop on LPs, again, that's the guys giving money to venture capital and other funds. For them, of course, they could ask, hey, now it's open, everybody could do it, why don't I just directly invest? Why would I need a fund? And that's basically the same reasons as we see today. Domain expertise is missing, early access. I think this is a topic Still, even though we have ICOs, we see a lot of pre-sales in this field, so a lot of funds are getting in early on, or we see some kind of hybrid financing rounds where the projects are first being backed by institutional investors, doing equity rounds, then build their products, and 2 to 3 years later actually go out with an ICO. We've seen that with IPFS, Filecoin, for example. Enigma is another one. They're like Civic, basic attention token, that they are much more. And I think this is going to continue. Okay, and yeah, regarding the outlook, I think we're still at the very beginning of this whole industry. Not software, but tokens are eating the world, to bastardize a famous quote from Mark Andreessen. There's much more to come. We are seeing it now with different token models, especially in the PE world. And there are much more assets to tokenize, such as stocks, real estate, fine arts, commodities, digital items in gaming, for example. And that's specifically interesting whenever you have physical goods which cannot be divided into many pieces, such as real estate, like flat would be the smallest unit of account. You could now basically make liquid and also divide it into much more pieces. And yeah, that's how the graph Sven showed could be continued over the next decades. There's many reports out there, and I picked the one from World Economic Forum predicting that we will go from an average market cap of about $100 billion 2017. Let's see how this year is going to end, to about 8 trillion billion market cap of tokenized assets in 2027, and that's 80x, multiple of 80 from now on. So I think this is gonna grow still, and even though there might be corrections, the overall tendency is growth. Yeah, that's basically it. Some short key takeaways. Still many unknowns. I'm kind of daily changing my mind on certain topics, right? So maybe if I need to have this talk in 2 weeks, I will tell you completely different stories. Could happen. Maybe ventures hit big, miss big approach or paradigm might shift in the future, just because of the liquidity. Venture will get further democratized, but only to certain degrees. I still think there will be room for institutional money getting in. And yeah, tokens are the future. Happy to discuss further on, and thanks for your attention.